IBM ditches 401k for cash balance plan. How it could impact the stock market. In a surprising move, IBM recently announced that it is replacing its 401k retirement plan with a cash balance plan, marking a significant shift in the way retirement plans are structured. This new plan, known as a defined benefit plan, resembles a pension but operates differently. While this change may be seen as beneficial for some employees, it has the potential to negatively impact the stock market as a whole. In this video, we will explore the implications of IBM's decision and its potential effects on the stock market. The shift from 401k to defined benefit plan. The 401k retirement plan is the most common type of retirement plan today, allowing individuals and sometimes their employers to make contributions into an account that they own and control. With a 401k, individuals have the freedom to choose how to invest their money, whether in stocks, bonds, or cash. They can also transfer their funds to a new retirement account when changing employers and withdraw money at any time. However, IBM's decision to replace the 401k with a cash balance plan changes this dynamic. Understanding the cash balance plan. A cash balance plan is a type of defined benefit plan where employees do not own the assets or have control over how they are invested. Instead, the company manages the investments and determines the amount employees can withdraw upon retirement. In essence, employees receive IOU notes from the company, promising to pay them back at a later date. While there is an organization called the Pension Benefit Guaranty Corporation that guarantees a portion of these pension payments, it is underfunded, meaning a collapse could require a bailout through money printing. Implications for employees and the stock market. IBM's decision to switch to a cash balance plan may be seen as a positive move for older employees who have not saved enough for retirement. With a defined benefit plan, they may receive a more substantial retirement benefit, potentially encouraging some to retire earlier. However, this shift also means that employees become dependent on the company's goodwill and competence to fulfill their pension obligations. The potential impact on the stock market arises from the fact that 401k contributions play a significant role in driving stock market growth. As employees automatically invest a portion of their paycheck into their 401k, the market experiences consistent buying pressure. However, if more companies follow IBM's transition to defined benefit plans, employees will no longer be investing in the stock market. This could lead to a decrease in demand for stocks, potentially causing a decline in stock prices. Conclusion. IBM's decision to replace its 401k retirement plan with a cash balance plan has the potential to reshape the retirement landscape and impact the stock market. While the move may benefit some employees, it could lead to a decrease in stock market demand if other companies follow suit. As the stock market becomes increasingly dominated by passive investing, a shift towards active investing may occur, with investors seeking undervalued assets. It is essential for individuals to stay informed and actively manage their investments to navigate these potential changes effectively.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.